Hello friends, welcome to Capital Budgeting Part 2. In Capital Budget Part 1, we discussed regarding the meaning of capital budget, importance of capital budgeting, and various techniques of capital budgeting. To understand those techniques, we took simple examples. Now in this video, we will understand those techniques in details along with their merits and demerits. The main topics included in this video are problem and solution on net present value and profitability index, merits of net present value, demerits of net present value, merits and demerits of profitability index. For that purpose, let us take an example. Friends, this example is taken from Sri Govind Guru University exam paper of last year. The example is in the following manner. Smithell Limited has two proposals of which the details are as below. Project A and Project B. The initial investment is rupees 6,60,000 for each project and the scrap value is 60,000 at the end of the life of 5 years. The second point states the estimated profit, that is before depreciation and tax. The table gives the details. During the first year, Project A gives a profit of 1,65,000, whereas Project B gives a profit of 3,30,000. Second year, Project A gives profit of 2,64,000. Project B gives a profit of 2,97,000. During the third year, Project A gives a profit of 3,30,000, whereas Project B gives a profit of 5,28,000. In the fourth year, Project A gives a profit of 3,96,000, whereas Project B gives a profit of 1,65,000. During the last year, that is the fifth year, Project A gives a profit of 4,62,000, whereas Project B gives a profit of 1,32,000. The rate of taxation is 50% and the company adopts the straight line method for depreciation. The directors have decided by considering risk factors for the rate of 15% capital cost for Project A and 10% capital cost for Project B. Now we have to determine net present value method and profitability index method, that which of the two proposals should be accepted. Friends, here in this example, a table showing the present value of rupee 1 for 5 years at the rate of 10% and 15% is given. So there is no need to calculate it in our solution. Now let us look at the solution of the example. The details of both the projects A and B are given. The initial investment is same, 6,60,000. Scrap value is same, 60,000. Estimated life is same, 5 years. Method of depreciation is same, the straight line method. Tax rate is same, 50%. Only the cost of capital differs, which will affect the discounting factor. So, in Project A, the cost of capital is 15%, while in Project B, the cost of capital is 10%. First of all, we will calculate depreciation. We all know the formula of depreciation. Initial investment minus scrap value divided by estimated life, which comes to 1,20,000 rupees per year of depreciation. First of all, let us calculate the NPV of Project Project A. First column is of year, the second is of profits from the project, third is of depreciation, then profit before tax, then profit after tax, then cash flows, then discounting factors, and then discounted cash flows. Now, during the first year, Project A gives you the profit of 1,65,000. Now, this is a profit before depreciation and taxes. So, we will deduct depreciation of 1,20,000 from it. So, profit before tax will be 45,000. 50% tax, that is 22,500, will be deducted. So profit after tax is 22,500. Cash flows will be calculated by adding back depreciation to profit after tax. So 22,500 plus 1,20,000 comes to 1,42,500. The discount factor at the rate of 15% for the first year is 0.870, which brings the discounted cash flow to 1,23,930. In the same way, the second year's discounted cash flow will be 1,45,180. Third year cash flow will be 1,47,941. Fourth year cash flow will be 1,47,512. Fifth year cash flow would be 1,44,678. Now friends, here there is one more cash flow during the fifth year or at the end of the fifth year, and that is rupees 60,000. That is nothing but the scrap value. Now friends, this is the method of net present value. Here, all the gains during the entire economic life of the asset is taken into account. So, the scrap value which we are going to get at the end of the project is also taken as an cash inflow. Now, if it is a cash inflow, it will be affected by tax also. We all know that whenever we dispose of an asset, if we earn any gain on it, it has to be charged to tax. Now, in this case, the scrap value is 60,000 and the book value is also 60,000 at the end of the life. So there is no question of tax. But if the book value is different from the scrap value, then a capital gain would arise and which will be subject to taxation. Now in such cases, after tax salvage value has to be taken into account. So let us see what is the formula for calculating after tax salvage value. The formula says after tax salvage value is equal to salvage value minus into bracket salvage value minus book value, that is the difference between salvage value and book value, multiplied by the tax rate. In this case, both values are the same, so tax would be 0 because 60,000 minus in bracket 60,000 minus 60,000 into 50%, so tax comes to 0. The after tax salvage value is 60,000 only, which we write in the column of cash flow, which will be discounted by the discount factor at the rate of 15% for the fifth year, that is 0.497, and hence the cash flow would be 29,820. This will bring the total present value of cash inflows to 7,39,045, from which we will deduct the initial investment of 6,60,000. So the net present value would be 79,045. Now let us side by side calculate the profitability index with the same details. Profitability index is equal to present value of cash inflows divided by present value of investment. So 7,39,045 divided by 6,60,000, which brings the profitability index to 1.12. Now let us see the net present value of project B. So during the first year, project B gives a profit of 3,30,000. From this, we deduct depreciation of 1,20,000. So profit before tax comes to 2,10,000. 50% tax, so 1,05,000 is the tax. After deducting it, we get a profit after tax of 1,05,000. Cash flows will be profit after tax plus depreciation, so it comes to 2,25,000. Discount factor for the first year at the rate of 10%. Remember, the cost of capital for project B is 10%, and so discounting rate is also 10%, is 0.909. So the discounted cash flow comes to 2,04,545. In the same way, the cash flow of second year is 1,72,314. Third year, 2,43,426. Fourth year, 97,329. Fifth year, 78,236. Here also we have a salvage value of 60,000, same way as we have salvage value of project A. So 60,000 will be recorded as a cash inflow multiplied by the discount factor of the last year 0.621, we have 37,260. When we sum up all the cash flows, we get the total present value of 8,33,111. From that, we deduct the initial investment of 6,60,000, which brings the net present value to 1,73,111. Profitability index for this project will be 8,33,111 divided by 6,60,000, which comes to 1.26. Now, decision making. If NPV is considered, we can see that NPV of both the projects is positive, but NPV of project B is higher. So, if NPV is the criteria, we should select project B. If profitability index is the measure, then we can see that project A has an profitability index of 1.12, while project B has a profitability index of 1.26. So if this criterion is taken into account, then also project B will be selected. Now let us focus on the merits of this method. The net present value method gives importance to cash flows instead of profit. Now friends, when we calculate profit, we deduct all the expenses from income and arrive at the profit. While doing so, we deduct various non-cash expenses also. The classic example is of depreciation. So we do not get a correct idea that how much cash flow we are getting from the project. And for that purpose, in net present value method, we take into account cash flows and not profit. For that purpose, first we deduct depreciation and tax from profit and then add back the depreciation amount to the profit after taxes. This method takes into account time value of money. We all know that a rupee today is much more important than a rupee tomorrow. The importance of time in the value of currency is much applauded, and so this method takes into account time value of money. This method considers the entire economic life of the project or an asset. This method considers both changing value of currency and interest rates. When a question is of selection between two mutually exclusive projects, this method becomes very useful in selection. Now let us see what are the demerits of this method. Friends, this method is a bit difficult in calculation and understanding as compared to other methods like payback period or accounting rate of return. You have to assume a discount rate, you have to discount the cash flows, and then you have to find out the NPV. So it becomes a bit difficult. Now, decision rule considers only the net present value. If the net present value is positive, you select the project, and if it is negative, you reject the project. But what about the quantity of initial investment required for the projects? This method does not take into account this problem. Now, discount rate is dependent on cost of capital. We all know that discount rate is determined based on the cost of capital, which is determined based on the risk factors. Now, all these determination of rates is a bit complicated and its calculation is a bit complicated also. The net present value method depends on the estimates of the useful life of the project. Once you estimate the useful life of the project, then you estimate the expected cash flows from it. Hence, if the estimates are not accurate, then the calculation would not give accurate results. This method may not give satisfactory results. where two projects having different effective lives are being compared. If other things are equal, then projects having shorter economic life are selected. However, this method does not attach importance to shorter economic life of projects. Now let us see what are the merits of profitability index. Now we all know that the details required to calculate profitability index are available from the table of net present value, and so we can say that this method has most of the merits of the net present value method. Secondly, the most important benefit is this method is helpful in the situation of capital rationing. Now, capital rationing is a situation where there is a cap or where there is a limit on the amount of expenditure which a firm can undertake. Now, there are many reasons for capital rationing and we don't go in details, but when such situations are there, then the project which gives the highest profitability index will be selected. Now, let us see what are the demerits. There is a possibility that a project with lower profitability index may produce higher cash flows in the initial years, which may be invested in other projects and increase overall profitability. In such a case, a project with lower PI may be selected. But if profitability index is a measure of selection, then the firm would select only those projects which have high profitability index, and hence this benefit would not be available to the firm. This method cannot be used in capital rationing situation if projects are indivisible. Once a project with higher PI is selected, the possibility of accepting several small projects which together may have higher NPV than single project is excluded. So friends, in capital budget part 2, we studied regarding net present value method and profitability index method. Wait for capital budget part 3, which would include problem and solution of internal rate of return, merits of IRR and demerits of IRR. Thank you.